Imagine this. Thousands of people from across the United States fly thousands of miles to Omaha, Nebraska, just to step into my office at Berkshire Hathaway, hoping to see the real secret behind enormous wealth. They expect rows of supercomputers' algorithms flashing across dozens of screens and a team of mathematical geniuses working around the clock. Instead, they see an old man sitting quietly at a simple wooden desk reading an old book about investing. They are disappointed. They want a complex formula, a secret that only the most intelligent minds can grasp. But today I will tell you the truth. The secret to winning in investing and in life does not lie in superior intelligence or advanced technology. It lies in something far simpler and far more difficult. Dear American investors, if you are willing to face this uncomfortable truth, join me as we explore 5 rules that helped Charlie Munger and me build one of the greatest financial empires in history. While many Wall Street prodigies went bankrupt overnight, ladies and gentlemen, look around at your own life right now. You probably know someone extremely intelligent, the type who earned perfect scores on every exam, graduated from a prestigious Ivy League university, and can solve complex equations in their head. Yet if you look more closely at their present reality, you may see them drowning in credit card debt in their 3rd marriage, under constant chronic stress, and spending 40 hours each week taking orders from a boss who barely qualified to graduate from high school. How does this happen? How does a certified genius become a wage slave and live a life of quiet desperation? The answer is simple and brutal. Society sold us a grand lie from childhood. The education system and the media keep repeating that intelligence quotient IQ is the golden ticket. They make you believe that the smartest person in the room always wins. I have been in this game for more than 70 years. I have watched countless brilliant people lose everything. And I have always said one thing: investing is not a contest where a person with an IQ of 160 defeats someone with an IQ of 130. In fact, if you have an IQ of 160, do yourself a favor and sell 30 points to someone else. You do not need them. In the game of long-term wealth building, those extra points often destroy you. Dear American investors, this is the painful lesson the stock market teaches every day. We live in a culture that worships academic achievement and intellectual superiority, where people assume that graduating from Harvard or MIT guarantees wealth. In reality, those brilliant minds often dig their own graves through overconfidence, by overcomplicating everything, and by refusing to follow the simplest principles. Meanwhile, ordinary investors who are patient and disciplined quietly move ahead. That is not luck. It is a fundamental law of the market. Today we will expose that lie so you do not fall into the same trap. To understand this more clearly, imagine that your brain is like a car. Your intelligence, your processing speed, your raw IQ, that is the horsepower of the engine. A true genius owns a twin-turbo Ferrari engine with 1,000 horsepower roaring under the hood. It is beautiful. It is powerful. It is impressive to look at. But here is the physical reality: horsepower is useless without a steady steering wheel. Rationality, emotional discipline, and a strict operating system, those are your steering wheel. If you install a 1,000 horsepower engine in a car with broken steering and no brakes, you will not win the race. You will simply crash into a solid brick wall faster and harder than everyone else on the track. This is the tragic flaw of highly intelligent people. They often lack the steering wheel. Worse, they use their immense cognitive power to rationalize terrible emotional decisions. Highly intelligent individuals tend to despise simple rules because those rules offend their ego. They think, I am a genius. It cannot be that simple. There must be hidden complexity. So they invent extremely complex mathematical models to justify buying into an absurd financial bubble. They overanalyze their careers until they are paralyzed by analysis. They use an enormous vocabulary to win meaningless arguments with their spouse, burning down their own relationship just to prove they are right. Their intelligence becomes a weapon of self-destruction. By contrast, my partner and I did not build an empire by having the biggest engine. We built it by having the best steering wheel. We never tried to be smarter than everyone else. We simply wake up each morning and try to be a little less foolish than we were the day before. You may own only a very average engine, like a simple and reliable 4-cylinder Ford engine. But if your steering wheel is perfectly aligned, if you keep your eyes on the road and simply avoid driving off a cliff, you will eventually pass the Ferrari that crashed in the first mile. Dear American investors, in a volatile stock market such as the S&P 500, this lesson becomes even clearer. I have seen many intelligent traders use complex technical analysis models to trade options or futures only to suffer heavy losses because of one emotional decision. Meanwhile, ordinary investors who consistently hold exchange-traded fund, index funds, and resist short-term temptations steadily accumulate solid wealth over time. That is not random. It is the power of discipline prevailing over raw intelligence. And this combination will help you whether you are managing a 401k retirement account or building a personal portfolio. Avoid the fatal mistakes that Wall Street witnesses again and again. That is the purpose of this presentation. Today, I will not teach you how to read a cash flow statement or give you secret stock picking tips. Those are only temporary tools. Tools change, markets collapse, technology advances. But human nature, the biological hardware of fear, greed, and envy, never changes. After more than 90 years on this earth, I have encoded a specific operating system built on 5 foundational rules. These are iron laws that kept me alive and compounding wealth while celebrated geniuses on Wall Street were losing their sanity and going bankrupt overnight. I must warn you before we continue, these 5 rules are extremely simple to understand. A child could grasp them, but they are brutally difficult to execute. They will require you to fight your own ego, to look foolish in front of your neighbors, and to forget much of what the system taught you about advancing your career and investing. If you are ready to stop drifting, if you are ready to take the steering wheel and control your machine, pay close attention. For you American investors facing inflation, interest rate volatility from the Federal Reserve and global competition, these rules are not theory. They are practical tools for building durable wealth. They help you survive crises such as the dot-com bubble of 2000 and the recession of 2008 without being a mathematical genius. Explore them carefully and you will see how profoundly they can transform your approach to investing. Let us begin with rule number 1. I call it the 20-slot punch card, also known as the art of absolute subtraction. We live in a world where busyness is celebrated as a status symbol. If you ask someone how they are doing, they will straighten their shoulders and proudly say, I am very busy. I am managing 5 different businesses, learning 3 new languages, and investing in real estate, equities, and startups at the same time. They wear exhaustion like a badge of honor, believing that motion equals progress. But motion is not progress. A rocking chair has plenty of motion, yet it never goes anywhere. It simply burns energy for no useful result. Most people operate under a false assumption: to get more out of life, you must put more into life. They suffer from an addiction to adding, believing that success comes from saying yes to every opportunity that appears on the desk. Let me explain the difference between successful people and truly successful people. Truly successful people say no to almost everything. When I speak to college students, I always present a specific thought experiment. Imagine that upon graduation you are given a lifetime punch card. This card has only 20 slots, meaning 20 punches. Each time you make a major financial investment decision or an important career choice, you must punch one hole in the card. But here is the critical rule: once you have used all 20 punches, your card is confiscated. You are permanently forbidden from making any more major decisions for the rest of your life. Think about the psychological impact of that card. If you knew you had only 20 bullets for your entire life, how would you behave? You would not swing at every pitch. You would not invest your hard-earned savings in your brother-in-law's new restaurant just because it sounds fun. You would not buy a highly speculative internet stock simply because your neighbor bragged about it at a weekend barbecue. You would stop drifting. You would become extremely patient sometimes, waiting for years, studying, reading, and observing. You would wait for the perfect fat pitch, the rare opportunity that can change your life. And when that opportunity finally appears, you would punch one of those precious slots and invest heavily. This is how my partner and I built our empire. We did not make 10,000 brilliant decisions. Over a period of 50 years, the majority of our wealth came from perhaps only 10 or 12 truly exceptional decisions. We simply sat in a room reading and said no to 99% of what came across the desk. To master this rule, you must understand a harsh truth about human psychology. Bad ideas are not your greatest enemy. You are intelligent enough to avoid them. If someone asks you to put all your savings into a fraudulent scheme, your brain immediately detects danger and you run. The real enemy is good ideas, projects with moderate returns, side jobs that seem interesting, or social invitations that are mildly entertaining. They are dangerous because they are attractive enough to justify your time, but they are not extraordinary. And because they are not extraordinary, they will never deliver exponential, life-changing returns. Yet they will do something terrible. They will drain your cognitive bandwidth, steal your focus, and leave you with no energy when a truly great idea finally appears. Every time you say yes to a good idea, you are quietly killing a great one. You have a strictly limited amount of energy each day. If you divide that energy equally across 20 different projects, you will move each one forward by only an inch. You will remain invisible, but if you concentrate all of it on just 2 projects, you will move them forward by a mile. Think of a magnifying glass. If you move it around a sheet of paper, nothing happens except the paper becomes slightly warm. But if you hold it steady and focus the full power of the sun on one small point, you ignite a blazing fire. You must become a laser. Dear American investors in markets such as the Nasdaq or the Dow Jones, where thousands of tempting stocks appear every day, this rule becomes even more critical. I have seen many young investors enthusiastically diversify their 401k portfolios by investing in every promising startup, only to dilute their resources and miss a major opportunity such as buying Apple shares in the early stage. Focus is not limitation. It is the key to multiplying returns. When you apply the art of subtraction, you do not only protect capital, you also optimize time, allowing you to outperform those who are busy but ineffective. Here is your assignment for rule number 1. Become a ruthless assassin of your own good ideas. Take a sheet of paper and write down the top 25 things you want to achieve in life. Circle the 5 most important ones. They are your destiny. The remaining 20 items are not secondary priorities. They are your enemies. Treat them like toxic waste and never spend a single second on them until the top 5 are completed. You must master the art of subtraction. You must guard your punch card as if your life depends on it. Rule number 2. I call it defeating Mr. Market, also known as the absolute necessity of emotional separation. Let us begin with a basic biological reality. As a human being, you are programmed to fail at building wealth. Your brain did not evolve in a modern financial system. It evolved in the Stone Age. Tens of thousands of years ago, the survival of our ancestors depended entirely on herd psychology. If you were walking in the forest, and suddenly the entire tribe began running in terror, you did not stop to analyze the situation. You did not ask for a data sheet. You ran immediately. If you paused to calculate probabilities, you were eaten by a tiger. Fear and social conformity kept our ancestors alive. But in the modern wealth game, everything is reversed. The herd is almost always wrong. Following the crowd in financial markets guarantees average results at best and total destruction at worst. When I was young, my teacher Benjamin Graham taught me a metaphor that completely changed the way I see the market. It was the most profound lesson I ever learned in business. He told me to imagine that you own a small share of a business and you have a partner in this business. Let us call him Mr. Market. Mr. Market is a very enthusiastic partner. Every single day without fail, he knocks on your door and offers a price at which he will buy your share of the business or sell his share to you. Here is the crucial point. Mr. Market suffers from a severe, untreated psychological disorder. He is wildly manic depressive. Some days Mr. Market is extremely euphoric. He sees nothing but endless sunshine and economic miracles. On those manic days, he fears that you will buy him out and capture future profits, so he offers you an outrageously high price for your share. On other days, Mr. Market falls into deep depression. He sees nothing but disaster, political chaos, and total economic collapse. On those dark days, he is terrified of the future and only wants to escape. He knocks on your door and offers to sell his share at a tiny fraction of the company's intrinsic value. This is the ultimate test of your rationality. Mr. Market is not there to guide you. He is there to serve you. His wallet is your opportunity. His mood swings are not your instructions. Most people allow Mr. Market to control their emotions. When he is euphoric and prices surge into the sky, they feel intense envy. They see their neighbors getting rich, so they rush in and buy at the peak of the frenzy. When Mr. Market is depressed and there is metaphorical blood in the streets, they feel intense panic. They sell their savings at the very bottom and permanently lock in destruction. I have a very simple rule. 1, you have probably heard, be fearful when others are greedy, and be greedy when others are fearful. People like to print that sentence on coffee mugs and posters. They nod and think they understand it. They do not understand the pure psychological pain required to execute it. Being greedy when others are fearful is physically painful. When the market collapses and television commentators shout that the global financial system is breaking apart, your stomach tightens. Friends call you and beg you to sell everything. Your primitive brain screams at you to run with the herd. Stepping forward to buy at that moment requires you to become a cold, calculating machine. It demands absolute emotional separation. You must build a fortress around your mind. You must train yourself to see plunging stock prices not as a physical threat but as a mathematical mispricing. You must disconnect ego, pride, and adrenaline from the flashing red and green numbers on the screen. This is exactly why my partner and I chose to remain in Omaha, Nebraska. We deliberately stayed thousands of miles away from Wall Street. We wanted to be as far away as possible from manic, depressive shouting. We wanted to sit in a quiet room and evaluate the intrinsic value of businesses completely separated from crowd emotion. If you cannot control your emotions, you cannot control your money. Dear American investors in markets such as the New York Stock Exchange or the NASDAQ, where news from CNBC or Fox Business can shake emotions every single day, this rule becomes a survival weapon. Remember the financial crisis of 2008. When people panicked and sold indiscriminately, those who remained calm and purchased high-quality companies at discounted prices generated enormous returns in the following decade. Those who followed the herd were wiped out. Today, with volatility driven by Federal Reserve interest rate decisions and geopolitical tension, emotional separation does not only prevent losses, it transforms crisis into opportunity. The difference between an average investor and a legend is not intelligence. It is mastery over instinct. Here is your assignment for rule number 2. The next time the world panics and the market enters free fall, turn off the television. Log out of social media. Do not consume the news. Study the balance sheet. Study the cash flow statement. Calculate intrinsic value. If the underlying value is solid and the price is irrationally low, act decisively. Step forward and swing. If the value is not there, do nothing. Do not allow a manic, depressive partner to dictate your destiny. Master your primitive brain, or it will master you. Rule number 3. I call it the mathematics of survival, also known as the margin of safety. Whenever people ask me for my top investment advice, I always give the same answer. I tell them I have only 2 simple rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. People often laugh when they hear this. They assume it is just a clever joke from an old man. They believe it is impossible to avoid losses completely. But I am not joking. I am stating a strict mathematical law of the universe. The biggest mistake highly intelligent people make is that they obsess over the upside. They spend all their time calculating how much money they can make. They dream about yachts and large mansions, but they completely ignore the downside. They never calculate the consequences of being wrong. Let me explain the brutal arithmetic of destruction. Suppose you have $100,000 and you lose 50%. You are left with $50,000. To return to your starting point, you do not need a 50% gain. You need a 100% gain. You must work twice as hard and take twice the risk just to get back to zero. If you lose 90%, you must gain 900% just to break even. This is the negative compounding effect of capital loss. Once you fall into such a deep mathematical hole, the walls are almost impossible to climb. In the late 1990s, there was a hedge fund managed by some of the most brilliant minds on the planet. They employed mathematical geniuses, even Nobel Prize winners in economics. They were so intelligent that Wall Street admired them, but they used enormous borrowed money, what we call leverage, to amplify returns. They wanted to get rich a little faster. Then an unexpected event occurred in global markets. Their models collapsed. Because they had borrowed too much, they were completely destroyed. They lost billions of dollars and nearly brought down the entire global financial system. They risked what they had and what they needed in order to gain what they did not have and did not need. That is absolute madness. It is like playing Russian roulette. If someone offers me a revolver with 1 million chambers and only 1 bullet inside and promises $1 million if I place it against my head and pull the trigger, I refuse immediately. I refuse because the upside of $1 million is not worth the infinite downside of death. A zero at the end of any multiplication equation turns the entire equation into zero. You must protect yourself from zeros. To do that, you must build what my teacher Benjamin Graham called a margin of safety. When an engineer builds a bridge and knows that 10,000-pound trucks will cross it every day, he does not design the bridge to hold exactly 10,000 pounds. If he did, the bridge would eventually collapse. Instead, he builds it to easily support 30,000 pounds. That extra 20,000 pounds of strength is the margin of safety. It protects the bridge from bad weather, aging materials, and heavy traffic. You must construct your financial and personal life the same way an engineer builds a bridge. If you need $5,000 per month to survive, do not build a lifestyle that requires exactly $5,000 per month to maintain. If you do, one medical emergency or the loss of one client will destroy you. Do not borrow money to buy stocks. Do not put your family home at risk to finance a business venture. Leave room for human error, bad luck, and the unpredictable chaos of the world. If you build a large margin of safety, you remove stress from your life. You will sleep peacefully each night and ignore the panic on television. Dear American investors in volatile markets such as the S&P 500 or the NASDAQ, where events like the recession of 2008 erased millions of portfolios in an instant, the margin of safety is not theory. It is a survival shield. I have seen many intelligent traders use margin to leverage their positions only to face a margin call and lose everything when the market reversed. In contrast, those who kept low debt ratios, maintained cash reserves, and prioritized safety survived the crisis without damage. Some even purchased undervalued assets and multiplied returns afterward. The difference between survival and bankruptcy is not speed of profit. It is shock tolerance. Here is your assignment for rule number 3. Conduct a full stress test on your life. Review your debts, your investments, and your monthly expenses. Are you driving a 10,000-pound truck across a bridge built for 10,000 pounds? Are you one small mistake away from total disaster? If the answer is yes, repair the bridge immediately. Reduce leverage. Build cash reserves. Accept lower returns in exchange for absolute survival. In the end, the winner is not the one who drives the fastest. The winner is the one who never crashes. Rule number 4. I call it the undeniable gravity of human association, also known as the absolute necessity of choosing your heroes. We live in a culture that worships the idea of individual willpower. We are fascinated by the myth of the lone wolf, the self-made individual who overcomes every obstacle through inner strength alone. Motivational speakers preach that if you grind hard enough, read enough books, and build enough internal power, you can conquer any toxic environment. Let me speak plainly. Willpower is a biological illusion. Willpower is like the battery in a mobile phone. You wake up each morning with a full charge. By 3 in the afternoon, after fighting traffic, making decisions, and dealing with difficult people, the battery is drained. Your willpower is gone. Your environment, however, the people you interact with daily, is not a battery. It is a gravitational field. It pulls on you 24 hours a day, 7 days a week. It never gets tired. You cannot outsmart the gravity of your environment. If you spend time with 5 people who constantly complain about their jobs, drink heavily every weekend, and blame the economy for their financial problems, I can guarantee with mathematical certainty that you will become the 6th. You will unconsciously adopt their language, their excuses, and lower your personal standards to fit in because the primitive human brain is designed to seek social harmony. You become exactly what you are around. The opposite is also true. If you force yourself into a room with 5 self-made millionaires, people who read relentlessly, take absolute responsibility for their failures, and operate with the highest ethical integrity, you will inevitably become the 6th. Their elevated standards will become your new baseline. When people ask about the secret behind the success of our empire, they expect complex theories about compounding or market timing. The real secret is my partner, Charlie Munger. Let me give you the most important financial advice you will ever receive. The most critical financial decision of your entire life has nothing to do with equities, real estate, or venture capital. It is whom you choose to marry and whom you choose as a business partner. I chose Charlie because I wanted a partner who would force me to raise my standards. I did not want someone who always agreed with me. I did not want an employee. I wanted someone extraordinarily capable, someone who read more than I did and who had the courage to look me in the eye and tell me my idea was completely foolish. If I had partnered with someone of lower character or ability, my net worth today would be a small fraction of what it is. This is the tragic mistake highly intelligent people often make. They allow their fragile ego to guide their friendships. The human ego loves the feeling of superiority. It wants to be the smartest person in the room. It feels comfortable when others listen. It feels safe when it has all the answers. Here is the harsh warning. If you look around and realize you are the smartest person in the room, you are in the wrong room. You are not growing. You are slowly decaying. If you truly want to win the game of life, you must deliberately seek rooms where you are the least knowledgeable person. You must intentionally seek people who make you feel inadequate. Surround yourself with individuals whose discipline and intellect intimidate you. When you are surrounded by giants, your brain has no choice but to adapt. You will stretch automatically just to survive in that elevated environment. Dear American investors in the competitive financial world of Wall Street and investment conferences in New York, this gravitational force becomes even clearer. I have seen many talented young investors choose friends to protect their ego, only to repeat common mistakes such as herd investing or ignoring risk. In contrast, those who intentionally join mastermind groups with seasoned investors, attending seminars of the CFA Institute, or building relationships with leading investment funds, elevate their portfolios to a superior level. Choosing heroes is not luck. It is a strategic investment decision. It helps you avoid emotional traps and learn from those who have already survived market storms, such as the downturn of 2020. Tell me who your heroes are and whom you associate with, and I will tell you exactly how your life will unfold. You will always move in the direction of the people you admire. Here is your assignment for rule number 4. Conduct a ruthless audit of your social circle tonight. Examine the 5 people with whom you spend the most time. Do they push you higher? Do they pull you down? Do they discuss significant ideas, or do they gossip about others? If they pull you down, you must have the courage to create distance. It may sound cold. It may seem harsh, but your survival depends on it. When you begin to do this, you will face social friction. The people you leave behind will not applaud you. They will try to pull you back to their level. They will call you arrogant. They will say you have changed. You must look them in the eye and say, "Yes, I have changed." That is the entire point. You must remove negative influences from your life, and you must deliberately recruit heroes who will pull you toward greatness. Rule number 5. I call this the ultimate non-confiscatable asset, also known as the law of internal compounding. Look at the news today. You will see a state of absolute panic spreading everywhere. People fear that inflation will erase a lifetime of savings. They fear that the government will raise taxes even higher. They fear that artificial intelligence will replace their jobs and make them obsolete. So, how do they respond? They run around like headless chickens trying to find an absolutely safe shelter for their money. They rush to buy gold. They pour into speculative real estate. They purchase highly volatile cryptocurrencies. They desperately build walls of physical assets to protect themselves from an unpredictable future. But they are missing the most basic law of economics. Every physical asset you own can be taken away. Real estate can be heavily taxed. Currency can be inflated by the government until it is nearly worthless. A business you built over 20 years can be destroyed by new technology in a matter of months. The stock market can decline by 50% in a single week. There is only one investment in the entire universe that is completely immune to inflation, immune to taxation, and immune to market crashes. That investment is your own earning power. The ultimate asset is your own mind. When I was young in my early 20s, I was paralyzed by a fear of public speaking. If I had to stand in front of a group and present an idea, I would feel physically ill. I simply could not do it. All of my intelligence, that powerful engine, was trapped inside my head. I realized that if I did not fix this weakness, my career would be severely limited. So I found an advertisement for a public speaking course by Dale Carnegie. The course cost $100, which was a significant amount of money for me at that time. But I paid and enrolled. In that classroom, I did not learn complex financial models. I did not learn how to value a stock. I learned how to organize my thoughts and communicate them clearly to others. Let me tell you the mathematical return on that $100 investment. It did not return 10%. It did not return 100%. It returned millions of percent over the course of my lifetime. If you cannot communicate effectively, it is like winking at a girl in complete darkness. Nothing happens. You may possess the greatest brain in the world. You may invent a cure for a deadly disease. But if you cannot express your ideas, your market value is essentially zero. On the other hand, if you simply learn to write well and speak clearly, you will immediately increase your lifetime earning potential by at least 50%. That is the ultimate form of leverage. You take the horsepower of your brain and finally connect it to the wheels of reality. But you cannot stop there. You must turn your brain into a compounding machine. People often ask me about the secret to success. They want a magic formula. I usually point to the massive stack of annual reports and books on my desk and say I read 500 pages like this every day. Most people immediately offer an excuse. They say they do not have time. The harsh truth is that they lack patience. They want shortcuts. They want a pill they can swallow once and wake up as a genius overnight. Knowledge does not work that way. Knowledge compounds exactly like compound interest. When you read today and learn a new mental model, it connects with what you learned 10 years ago and creates an entirely new network of understanding. No one sees this process. It is invisible to the outside world. But over decades, that slow, boring, and invisible accumulation transforms into an unstoppable intellectual force. You do not need extreme intensity. Intensity is often overrated. People are fascinated by the idea of studying for 20 hours in a single stretch. But intensity burns you out. What you need is consistency. Consistency is the most underrated force in the universe. Reading 20 pages a day does not sound impressive, but over 10 years that becomes hundreds of books. That is a knowledge empire. Dear American investors, while everyone is worrying about interest rate decisions by the Federal Reserve or volatility in the Dow Jones Industrial Average, remember this: you do not control the macroeconomic environment, but you fully control your most valuable asset, yourself. I have seen many intelligent people with advanced degrees from top universities remain stuck at an average level because they lacked communication skills and broad knowledge. In contrast, those who invested in reading, practiced communication, and built a strong mental framework moved far ahead of the crowd, even during crises such as the financial crisis of 2008 or the pandemic. When markets collapse, a brokerage account may temporarily shrink, but your intrinsic value, your ability to earn, adapt, and create opportunity remains intact. So here is your assignment for rule number 5. Stop obsessing over what the Federal Reserve is doing. Stop refreshing your investment portfolio every 10 minutes. Take that anxious energy and invest it in the only asset that guarantees long-term returns: your own communication skills and knowledge. Read one book each week about human psychology, history, or business. When the next economic crisis arrives and the crowd panics in the streets, your bank account may temporarily decline, but your intrinsic value will remain untouched. No one can tax your intellect. You will walk through the fire and come out stronger than ever. We have walked together through 5 foundational rules, from the art of absolute subtraction to separating emotion from Mr. Market, to the margin of safety, to the gravitational pull of your human environment, and finally to investing in your own mind. If you truly apply them with consistency, the mathematics of compounding in life almost guarantees that you will accumulate substantial wealth. But as we reach the final part of this presentation, I must offer one last warning. It is the most important lesson I learned after more than 90 years of living. I have met many of the wealthiest and most powerful people on this planet. I have seen individuals who own fleets of private aircraft whose names are placed on massive skyscrapers, who can pick up the telephone and speak directly to the President of the United States. They possess everything money can buy. Yet when they lie in a hospital bed during the final days of their lives, a dark secret becomes clear. No one truly loves them. Their children wait for them to pass away so the will can be read. Their spouse remains only for the inheritance. Their business partners view them as a tool that has expired. They hold billions of dollars in the bank, but they are completely bankrupt in the only currency that truly matters: genuine human affection. To me, that is the definition of absolute failure. I do not care how much money sits in your account. If you reach my age, and the people you wish to love do not truly love you, your life is a disaster. Money can buy many things, but it cannot buy love. I call this the rocking chair test. Imagine that you are 95 years old, sitting in a rocking chair on your porch, looking back at the long trajectory of your life. You will not think about your investment portfolio. You will not think about quarterly earnings. You will not think about the promotions you received in your youth. You will think only about people. Did you treat them well? Did you act with integrity? Did you build a fortress of trust? Or did you burn bridges just to earn a few extra dollars? Money is a wonderful tool. It provides freedom. It provides choice. It removes basic survival stress. But it does not purchase love. You can buy a yacht. You can buy a mansion. You can even buy the illusion of respect, but you cannot write a check for $1 million to purchase a single ounce of authentic human affection. The only way to receive love is to become a person worthy of love. Dear American investors, while you are building your investment portfolio, managing your 401k retirement plan, or monitoring volatility in the S&P 500, remember that financial wealth is only one part of a larger picture. It is a byproduct of a life well lived. Do not trade reputation for short-term profit. Do not trade family for a promotion. Do not climb the ladder of success only to discover that it is leaning against the wrong wall. Play the game. Play it with strength. Build wealth. But never forget that wealth is only a secondary outcome. Take these 5 rules and install them into your operating system today. Stop drifting. Take hold of the steering wheel. That is all. Thank you for listening. I wish you success not only in money but in building a life that is truly worth living.